Hey guys, okay, so it is 1:26. We waited to record the actual version of the recorded version here until after the market closed because of all the news and kind of activity that happened today. For those of you that were not on the call live this morning, I didn't record it because, well, for several reasons, but mostly just because I had hiccups and couldn't deal with it. And Jeff and Mindy here in our office uh, thought it would be hysterical to record a version with lots of hiccups and maybe even go viral being the hiccup guy, but we did not think that was a good idea. So we waited until we made sure those were all cleared up, and I think we did that. So I'm going to run through it real quick, and hopefully and I'll get to what the market did and what all happened here momentarily. First of all, let me put it in perspective about why we're here. As we work to get better, it's important to go back to the why and focus on the reason that we do what we do. And the reason that we're here is to help provide clarity from all the noise that's in the marketplace. We all get noise. We listen to it every day, whether it's in the coffee shop or on Twitter. Whatever it is, that noise tends to distract us, and the vision of this program is to help to provide some clarity from that noise. Second is we want to simplify your marketing program by making it objective and not emotional, and we do that through pictures and through the charts using a timing system that we've developed. And last but not least, we want to maximize your time. So throughout the week, we read um, uh, dozens and dozens of articles. I wish I could say with confidence that every article that's written about ag we read. That's probably not accurate because I'm sure we've missed some, but we really do our best to try to read them. And whether that's through a subscription service that we subscribe to or just general news flow that comes out through the week, we try to digest it, simplify it for you, and condense it down to a real short version so that we can help maximize your time. So with that, let's take a quick look at kind of where we're at, and then we'll jump to the conclusion because I know that's what we all want to see. So last week, the USDA's crop report kicked the can down the road and really didn't add anything conclusive to it. They did raise the crop a little bit, and they did uh, increase demand a little bit. But net, they really didn't do anything at all. USDA kicks the report down the road. There's really not much you can do about it. But I guess the report was bearish against trade expectations, and the response was bullish. So I think that just means that traders wanted to look towards China to see what they were going to do. And the basis levels throughout the country remain elevated. On this morning, we went through and looked at some of the basis charts. I'm not going to do that on the video here. I'll just reiterate that throughout the country, they are elevated against last year's spot price and the 3-year average of the spot prices. So all eyes today were on China. I'm sure by now you guys have all read and seen the news. China and the U.S. did sign the trade agreement. It seems to contain exactly what they said it was going to contain, but yet the market reaction really wasn't all that bullish. And it's probably a head scratcher. How is it not bullish when we have demand numbers that we haven't seen for years? And for the last 2 years, you know, the bears have even said, "Give us demand and we'll change our tune." Well, they didn't do that today. So let's you'll see that here in just a minute when we get to the charts. Let's go there. Let's go ahead and go there now and take a look at what happened. So here are soybeans. This is the daily chart. We've got, on this daily chart, we've got this big congestion zone trading right near the highs of where we've been for the last year. And clearly today, after the report, after the deal got signed, sellers emerged and pushed this market down through this congestion area here and moved it to a new low. So we'll see if we're starting a big move to the downside where we buy the rumor, sell the fact, or if we find some support right in here and this is kind of just a strange knee-jerk reaction to what should otherwise be a bullish news. It's not clear at this point what that means, but clearly the market did not react as bullishly as some would hope. So as we talked this morning, anything can happen in this business, and you got to be ready for it and mentally prepared to deal with it, which is why we had puts on. So we'll go through that here in just a second. Regarding wheat, wheat really didn't do much. We did make a new high today. We did close back flat. Not a hook reversal, not a major sign of distress in wheat, but clearly not the bullish reaction that everybody wanted. But it's still in the strongest uptrend of all the grains. Doesn't really have any end in sight. It just has moved quite a ways in a pretty short period of time. Corn, we said this morning that corn was neutral because we're inside our cloud, and that is absolutely exactly where we closed today. Not a great close given the news flow. You hate to see bearish reaction to bullish news like the trade deal, but we're inside the cloud, and so that's not uncommon and probably, frankly, shouldn't be surprising at all. We'll see if we can push lower or higher, and we plan to go with it. So a move above 392 would be bullish, and a move, a move all the way back down 376 here would be considered really bearish. In between the two, we'll just sideways range bound and not really having any sort of a bias one way or another. The corn bean ratio. I think this is important. We did not go through this morning, but given the news that we have today in the trade deal, I think it's important to look at. Corn actually gained acres to beans today, which is a very interesting conclusion for where we thought we might be. If China is going to buy a bunch, we thought that they might buy beans and have to push the spread wider in order to buy the acres. And that has not happened. So we'll see if this spread continues to break and if corn is going to buy acres from beans, which would kind of be a head scratcher in and of itself as well. I don't think you can take too many conclusions away from the way we closed today. The trade digested the trade deal for less than an hour from the time it was released to the time the market closed. So as we trade, Thursday, Friday, Monday, by the end of Tuesday, we should have a pretty good idea of how the trade feels about the trade deal and its details, and whether or not it's going to be enforceable, and whether we should need to move higher or lower. So I think the jury's still out on that, and we need to just stay tuned to it. So as we thumb back through them, beans broke, bearish reaction to bullish news. Corn did the same thing, and wheat also tried to follow suit, although with less selling pressure than the rest. So where are we, and what should we be doing? We have been listening to you guys and trying to give you what you want. And one of the things that you guys talked about is we want to know more about what to do. We want you to be more conclusive about your advice. So we're going to start doing this every week, where we give a positioning report saying this is where we think makes the most sense. And we're going to do that for both hedgers and for those of you that are speculating. So as far as corn goes, we hedged last week into long March 380 puts, and we want to hold those for another week to see how this trade digests. The reason we did March is because we think that's where the volatility is going to be. The spreads are relatively narrow. The future spreads are tight together, which means from March to May to July to December, there's not a whole lot of spread between them. And if that's the case, if that stays the case, then we don't really have too much to worry about, because hedging in the front month means that the back month won't get too out of whack from it. But if we're going to go to a carry market and this is going to be a bearish situation, then the front month is going to fall harder than any of the rest. So that's why we want to hold our hedges in the front as opposed to in the later month. Plus that the puts are cheaper, and if the market moves quickly, then you should be able to get out of them and have a very efficient trade. Why next Wednesday? Because there's about 30 days left in the life of that option, and we don't want to lose all our premium to time decay. So that's why Wednesday. That's why next Wednesday we'll reevaluate, choose a new month, choose a new strike, and go from there. Soybeans, same thing. We want to own 930 puts, and we should be basically out of old crop, fully priced, holding new crop risk, but getting rid of some of that risk in the March puts. Wheat, same exact thing. We bought at the money puts last Friday on May 480s or March 480s rather, and are just going to hold those for a few days as we digest the report. Speculators, those that wanted to be long, we've been in long futures, and I still think that's the place to be. Long futures with a stop on March corn at 380, stop at 930, which did get stopped out today, by the way, and Kansas City wheat long futures with a stop at 487. In my own account, I did not have a soybean future stop in, just for all transparency. We had soybean puts bought against futures into that account, so at this point there's no downside risk in that trade. The puts will offset any risk the futures have, and we'll just let them dance. So a long future, long put is the exact same position as the hedge over here with a long put, long cash. So because cash is equal to futures. So really these two positions are identical, and I hope that that's a helpful point to pull out or to comment on, because you can build positions however you want them to be, and whether you're in cash or whether you're on the board, the net financial result should always be about the same. So that's where we're at. I hope that's helpful, and we will talk to you guys next week.